Welcome back to the deep dive. Today we are locking the doors, turning off the news feeds, and really going deep into the financial system's plumbing.
The dark plumbing.
The really dark plumbing. We're talking about the stuff that, the Federal Reserve doesn't exactly put in its press releases, the actual transaction data.
And you have to start with the official story because it's everywhere. The mainstream narrative is all about responsibility, normalization.
Right. The Fed is shrinking its balance sheet, quantitative tightening, QT. The party's over.
Exactly. The era of easy money is done. They're the responsible parent who's finally taken away the credit card. That's the story they're selling.
And it sounds good. It sounds sensible. If you just read the headlines, you'd think, okay, financial sobriety is back. But, and this is the whole reason for this deep dive, when you ignore the press releases and look at the raw data.
The actual numbers, the overnight repo reports, the H.4.1 filings, the stuff buried on their website.
You find a smoking gun, an absolute contradiction.
The narrative says liquidity is shrinking. The hard data proves a massive covert liquidity injection is happening as we speak.
So we have to open what we're calling the smart money files. Because what we're seeing is a deliberate smokescreen. They're using complex language, bureaucratic jargon to do the exact opposite of what they claim. So our mission today is, I think, pretty straightforward. We're going to expose this technical shift that has created what we're calling shadow liquidity. We're going to look at the system's biggest buffer, how it worked, and why it failed.
And then we have to name the new machine, the stealth mechanism the Fed turned on to replace it.
Exactly. And then, and this is the most important part for you, the listener, we need to track the whales, the big money, guys like Stanley Druckenmiller. What are they doing with their capital now that they know this hidden truth?
It's about connecting the dots. The obscure Fed data on one side and your portfolio's performance on the other. This isn't just theory. This is about the value of your money.
Okay, let's get into it. The first piece of this puzzle is, or rather was, the financial system's biggest safety net, the Reverse Repo Facility. The RRP.
Right. For years, this was the hidden fuel tank, the shock absorber for all of global finance.
So conceptually, what was it? How did it work?
You have to think of it as like an overflow valve, a giant overflow tank, when the Fed was doing all that quantitative easing.
Pumping trillions into the system post-2008, and especially during the pandemic.
Exactly. All that new cash had to go somewhere. You couldn't just dump it all in the commercial banks. It would have completely destabilized their balance sheets.
And short-term interest rates would just collapse, right? They'd go to zero or even negative.
Precisely, which the Fed doesn't want. So the RRP was this place, this safe harbor, where non-bank institutions, we're talking about the big money market funds, Fannie Mae, Freddie Mac, they could park their excess cash overnight.
And they get a small risk-free return for it.
A tiny return, yeah. It was just a place to store cash safely outside the banking system proper. So it did two things. It helped the Fed keep a floor under interest rates, and it acted as this massive shock absorber for all that excess liquidity.
A giant savings account.
A giant savings account for the biggest players. And we really need to emphasize the scale here. It wasn't just big, it was historic. Through 2023, the RRP facility held, get this, $2.5 trillion.
2.5.
Trillion, with a T. I mean, think about that number. That is a gigantic cushion. If the system hit a speed bump, if a bank somewhere needed emergency cash, that $2.5 trillion was just sitting there, ready to flow back in.
It was the ultimate backstop, the guarantee that liquidity was always available, keeping the whole machine from seizing up.
Which brings us to today, and the reason we're even having this conversation. Because according to the source material we're looking at, that RRP tank, it's empty.
Gone. The balance has effectively hit zero. That $2.5 trillion buffer, the very foundation of stability for the last couple of years, has been completely drained.
The cushion is gone. Every single dollar has been pulled out. I mean, if you're going by the textbook, the disappearance of $2.5 trillion from the system's core should be causing a panic.
It should be a 5-alarm fire, a complete systemic crisis.
So why did the money leave? Was it a bank run?
That's the interesting part. It wasn't a panic. It was just simple self-interest. The money market funds found a better deal. As the U.S. Treasury started issuing massive amounts of short-term debt, T-bills, to fund the government deficit, those T-bills started offering a slightly higher interest rate, a better yield than what the funds were getting at the RRP.
So they just moved their money from the Fed savings account to government T-bills. A slow, methodical drain, not a sudden shock. Exactly. Over months and months, that $2.5 trillion just shifted, chasing that little bit of extra yield. But here's the critical part. When the buffer hits zero, the whole dynamic changes. There's no backstop left. The financial engine should be sputtering. It should be seizing up. Historically, this is the exact setup for a severe market crash.
It's not. I'm looking at the markets right now. They're not crashing. Indices are holding near their highs. The patient whose life support system just got unplugged is somehow, running a marathon.
That is the contradiction. That's the mystery we have to solve. The market should be in turmoil. You only have to look back at, 2019?
The repo spike, yeah.
The repo spike in 2019. There was a tiny liquidity crunch back then, and overnight lending rates spiked to 10% for a little while. The Fed had to jump in with emergency cash.
And that was a tiny issue compared to a $2.5 trillion drain.
A tiny fraction. So if that little hiccup required an emergency response, the complete disappearance of the system's main buffer should be a catastrophe. But silence. Why didn't the collapse happen?
Okay, I have a guess. The Fed didn't let it happen.
They didn't let the patient die. As the money was draining out the front door from the RRP, they quietly opened the side door and started pumping new money back in.
They just switched the IV drip from one arm to the other.
A perfect analogy. They moved the life support system to a quieter room, a darker corner of the financial plumbing where nobody was looking.
And this is where we get to the heart of it, the shadow liquidity. The market didn't crash because the Fed saw this coming, panicked, and turned on a brand new machine.
They had to. They had no choice. The repo market, that overnight lending market, it's the absolute bedrock of the whole system. If that freezes, all credit freezes. The economy just stops.
And when the RRP buffer disappeared, they knew that freeze was coming.
It was imminent. So they needed a new tool, an active tool, to inject reserves directly back into the banks to keep them lending to each other.
And our source material has the exact date they flicked the switch. December 10th, 2025. It wasn't some big press conference, it was buried. A quiet update to their operating procedures.
Buried deep in the technical notes. And the name they gave this new machine is, well, it's a masterpiece of bureaucratic obfuscation.
What is it?
Reserve Management Purchases, RMP.
Reserve Management Purchases? That sounds aggressively boring.
It's designed to be. It sounds like routine maintenance, like an accountant tidying up the books, something you'd never, ever question.
I've read the announcement. It's written to induce a coma, and the official reason they did it is just to, quote, maintain ample reserves.
Just housekeeping. Making sure the banks have enough cash in the till to meet regulations. That's the public story.
Okay, so our job right now is to translate that. What is RMP, really?
It's stealth QE.
Stealth quantitative easing. Let's break that down because that's a huge claim. The difference between reserve management and QE is the difference between normal and crisis.
It is. So let's define the terms. What's traditional QE? It's when the Fed buys assets, usually long-term treasury bonds, to stimulate the economy. They create new money out of thin air to buy those bonds, injecting cash into the system.
Right. QE is the big, loud money printer they roll out when things are bad. Everyone knows what it is.
Everyone knows. Now let's define RMP. RMP is when the Fed buys assets, in this case short-term treasury bills. They create new money out of thin air to buy those bills, injecting cash into the system.
Wait a second. So the only difference is the type of treasury they're buying. Short-term bills instead of long-term bonds.
That is the only material difference.
But the Fed would argue that buying bills is different.
Yeah.
That it doesn't affect long-term interest rates in the same way, so it's not as, stimulative.
And that's the genius of the disguise. Yes, buying bonds has a more direct impact on mortgage rates and things like that. But the immediate functional effect, the thing that matters right now, is identical. In both cases, the Fed is creating new money and injecting it into the banks. The mechanism is the same.
So they're running QE, but calling it something else to avoid a panic.
Absolutely. The name is a political shield. If Jerome Powell stood up tomorrow and said, "We are starting a new QE program," the market would freak out. Inflation fears would go through the roof. The dollar would tank. The whole normalization story would be exposed as a lie.
But by calling it reserve management purchases,
They keep the conversation confined to a handful of specialists and academics arguing about bank reserve requirements. They manage public perception through weaponized boredom.
This is more than just word games. They've created a parallel money printing program that flies completely under the radar, a shadow liquidity injection.
A shadow injection that's now the only thing holding the system together.
Okay, so let's move from the mechanism to the proofs.
Yeah.
We can track this, right? We can see the money. How much are they actually printing?
We can, and the number is, frankly, staggering. By digging into the Fed's own data, our analysis shows they are injecting roughly $40 billion a month into the financial system through RMP.
40 billion every single month.
40 billion a month. And you have to put that in context. Remember their other program, Quantitative Tightening, QT.
Yeah, the one where there's supposedly shrinking their balance sheet, draining liquidity.
Right. Well, this $40 billion injection is actively working against that. It's fighting their own stated policy. They're taking money out with one hand and secretly putting a huge amount back in with the other.
It's a total contradiction. 40 billion a month is not a technical adjustment. That's a fire hose of cash. It's life support.
It is 100% life support. It's not about stimulating the economy or creating jobs. This is purely reactive. Look at the timing. They turned on the RMP fire hose at the exact moment the RRP buffer ran dry.
Because without it, the repo market would have frozen.
Instantly. The banks were running out of ready cash. The risk of that 2019-style repo spike was turning into a certainty. This $40 billion a month is the tourniquet they applied to stop the bleeding. It proves beyond any doubt this was an act of pure necessity. They had no other choice.
So if the Fed is forced to print, that means the problem is bigger than just bank reserves. It has to be connected to the elephant in the room,
The national debt.
the $38 trillion anchor.
That's the fundamental constraint. The U.S. government is running massive deficits year after year. To fund that spending, the Treasury has to constantly issue new debt, trillions of dollars in new bonds and bills every single year.
And somebody has to buy all that new debt.
Somebody has to. And for decades, the buyers were reliable. You had foreign governments, China, Japan, who would buy huge amounts to manage their own currencies.
But that's changing.
It's changing fast. For geopolitical reasons, for diversification reasons, those foreign buyers are stepping away. They're either not buying new debt, or in some cases, they're actively selling what they already hold. The biggest customer just left the store.
What about domestic buyers, the big U.S. banks?
They're already full. Regulations require them to hold a lot of treasuries, but there are limits. They have capital ratios they have to maintain. They simply can't absorb trillions more in new debt without putting their own balance sheets at risk.
So, if the foreign buyers are gone and the domestic banks are full, who is left? Who is buying all this new government debt?
There's only one buyer left with deep enough pockets.
The Federal Reserve.
The Federal Reserve.
Yeah.
Through the RMP mechanism. That's what this is really about. RMP is the official disguised channel for monetizing the U.S. government's debt.
They're printing money to fund the government.
They have to. They have to print that $40 billion a month or more just to soak up the new bonds the Treasury is selling. If they didn't, there would be no buyer, Treasury prices would crash, interest rates would explode, and the cost of servicing that $38 trillion in debt would become instantly unsustainable. The whole system would collapse.
So they invented this boring, technical-sounding name to hide the fact that they are now the permanent backstop buyer for U.S. debt.
It's a trap. They're completely trapped. The size of the debt and the lack of other buyers has forced them into this cycle. They cannot stop. The moment they turn off the RMP machine, the entire market seizes.
This changes everything. The Fed isn't making policy choices anymore. They're just reacting. They are forced into this shadow printing just to keep the lights on.
Just to keep the government solvent.
Okay, so if the insiders know this, if the big players see this $40 billion a month covert injection happening, what are they doing? This is where we shift from the Fed's actions to the market's reaction. We're tracking the whales.
Right, because in a market this manipulated, the only thing you can really trust is the flow of money. The actions of the people who are too big to fool.
And our window into their strategy is the 13F filing, the public disclosures that show what the big institutions are buying and selling. And we're going to focus on one person in particular, Stanley Druckenmiller.
A legend, not just an investor, a true macro trader. This is the guy who, with George Soros, famously broke the Bank of England. His entire career is built on seeing when a central bank story doesn't match the data.
And he definitely sees the data we're talking about. So what did the $40 billion a month of stealth QE signal to him?
Yeah.
His filings show a massive, massive defensive rotation.
The first move is what he sold. While everyone, all the retail investors, the media, they were all piling into the AI bubble chasing the Magnificent Seven tech stocks, Druckenmiller was quietly selling. He was dumping millions of dollars of his tech exposure. He was getting out while the getting was good.
So he saw that AI-fueled rally not as some fundamental new economy, but as a final speculative frenzy powered by this hidden liquidity.
Exactly. He saw it as the last party on the Titanic. He recognized that when this RMP printing eventually leads to either hyperinflation or a deep recession, those high-flying, high-valuation stocks are the ones that get crushed first.
So he sold the hype. But he didn't just go to cash. You said cash is a trap.
Cash is a trap because it's being debased by the very printing he's reacting to. No, he rotated. He moved into two specific areas: defensive growth and hard assets.
Okay, let's take defensive growth first. The filings show him making a huge strategic buy into Teva Pharmaceuticals.
Right, Teva, a generic drug maker.
That seems completely random. It's so far away from the AI narrative. What's the logic there?
It's the ultimate recession-proof trade. Druckenmiller is betting that the shadow printing ends badly. One way or another, it leads to a severe economic downturn.
And in a recession, people change their spending habits.
Drastically. You stop buying the new iPhone, you cancel a few streaming services, you put off buying a new car. Those are discretionary luxuries. But what do you not stop buying?
Food, electricity, and medicine.
Medicine. People still get sick. Prescriptions still need to be filled, recession or not. The demand is completely inelastic. Teva sells things people need, not things they want.
So he's trading the speculative upside of tech for the stable, predictable cash flows of essential goods. It's a classic defensive play against economic chaos.
It's a bet on stability in a world of volatility. He believes the cash flow from selling essential medicine is a safer bet than the promise of future earnings from a tech company.
Okay, that makes sense. Now for the second part of the trade, the more direct hedge. He moved into gold and other hard assets.
This is the explicit bet against the dollar. It's the insurance policy. When you see your government funding its spending by printing money, you buy gold. It's the oldest rule in the book.
And it's not just him. This isn't one lone wolf making a contrarian bet.
Not at all. You have to zoom out. Look at what the central banks around the world are doing. In the third quarter of 2025 alone, the exact same time the RRP was hitting zero and RMP was ramping up, global central banks bought 220 tons of gold.
220 tons. In 3 months.
It's a historic pace of accumulation. They're desperately trying to get out of dollars and into a neutral hard asset.
So you have the world's smartest macro trader, Stanley Druckenmiller, and the world's central banks, all doing the exact same thing at the exact same time.
They're all reading the same tea leaves. They see the $40 billion a month being printed. They understand that RMP is just a fancy name for debt monetization. And they know that debt monetization always leads to currency debasement. Gold is the only life raft.
They are betting on the math of the $38 trillion debt, not the words of the Federal Reserve Chairman.
They're front-running the inevitable consequences.
Okay, this is the point where we need to bring it all back to the listener. We've laid out the mechanism, the proof, the reaction of the whales. So what does this hidden $40 billion injection mean for your money, for your portfolio?
Right. We need to distill this down into actionable verdicts from the smart money files. And verdict number one is the most important. You have to avoid the cash trap.
This feels counterintuitive. When you hear about instability and secret money printing, the first instinct is to sell everything and hide in cash.
That's the old playbook. And it's a dangerous mistake today. In the past, you could wait for a crash in cash because your dollars would hold their value. But now, the crash you're waiting for is being actively prevented by the RMP printer.
They're printing $40 billion a month precisely to stop that crash from happening.
And every month they do that, your cash loses purchasing power. The inflation might be hidden, it might not show up in the official numbers right away, but the debasement is real. Holding cash is no longer a zero-risk position. It's a guaranteed loss of purchasing power over time.
You're trading the risk of market volatility for the certainty of currency devaluation.
Exactly. So sitting on the sidelines is not an option, which leads to verdict number two. You have to watch the RMP number. This is the new vital sign for the market's health.
How does someone who doesn't have a Bloomberg terminal track this?
It's actually public if you know where to look. The New York Fed publishes its monthly purchase schedule for these RMPs. You can also see the effects in the Fed's weekly H4.1 report. You just have to monitor that number.
And right now, that number is around $40 billion a month. That's the baseline, the minimum needed to keep the system stable.
Yes, that's the current dose of medicine. But the red flag, the real warning sign, is when they have to increase the dosage. If the system gets sicker, if banks start hemorrhaging reserves for some other reason,
We'll have to print more to keep it alive.
they'll have no choice. So if you see that monthly RMP number jump from 40 billion to 60 or 70 billion, that is the signal. That tells you the system is failing much faster than they expected. It's a sign of panic inside the Fed.
And that jump should trigger an immediate move into even more defensive assets, because it means they're losing control.
They're losing control of the pace of the printing, which takes us to the final verdict, verdict 3, the smart head. Follow the whales.
You don't need to be a billionaire to copy the logic. Druckenmiller's playbook is right there in the public record.
It's a blueprint. You start with hard assets. An allocation of gold and silver is no longer a fringe idea. It's a necessary insurance policy against the reality of dollar debasement from the RMP printer.
And then you mirror the defensive growth part of his trade, the Teva Pharmaceuticals move.
You don't have to buy that specific stock, but you need to understand the principle. Allocate capital to sectors that are resilient, things people buy no matter what. Utilities, consumer staples, waste management, other healthcare companies, businesses with stable cash flows that can withstand an economic storm.
So the final takeaway is, understand that the market stability is artificial, it's propped up by secret printing, and position yourself in assets that either benefit from that printing, like gold, or can survive the chaos it will eventually cause, like defensive stocks.
You have to align your strategy with the reality of what they're doing, not the fantasy of what they're saying.
So let's just recap this. It's a pretty unsettling picture. The Fed tells the world everything is getting back to normal, the balance sheet is shrinking, but the data shows they are trapped, forced to panic print $40 billion every month through a disguised program just to stop the $38 trillion debt machine from collapsing.
And the smart money sees it. Druckenmiller, the central banks. They're not listening to the press conferences. They're watching the data. They're selling the hype and buying gold and essentials. They're getting on the math.
So the question for you, the listener, is really simple. Who do you believe? The calming words from the institution that's creating the problem? Or the hard, multi-billion-dollar actions of the people who are hedging against it? This stability we're seeing is an illusion, paid for with $40 billion in stealth QE every single month.
Which leaves us with one final provocative thought. We've established that the Fed cannot stop printing. They are locked in. The debt has to be funded. The dollar has to be debased. So if this is the new permanent reality, what major global asset, what commodity that's currently flying under the radar will benefit the most when the rest of the market finally wakes up and realizes that RMT is just uncontrolled permanent debt monetization?
That is the question of the next cycle. We'll leave you with that one to think about. Thank you for letting us take this deep dive into your source material. We'll see you next time.